I'm Joshua Roberts of Biz News, and with me today is TreasuryONE's Andre Cilliers. Andre, we spoke around a month ago, and the rand dollar price was around 16 rand to the dollar, now trading around the 15 rand 60 mark. What were the main driving factors that drove the rand during the festive period?
Well, during the festive period, we had an interesting time in the sense that markets was very thin. Liquidity is always very thin in those periods. And we had actually seen the rand weakening at one stage to well above the 16 level. And we had a bit of a seesaw, especially in the beginning of the year, where it came down to the 1580 level, then jumped back up against the 16 level. And there were small factors linked to interest rates. Emerging markets as such pulled a little bit of a negative one. We've seen some of the emerging markets weakening. But I want to ascribe that nothing significant other than very thin liquidity and very thin on the new side. And even the smallest and slightest bit of movement, be it a gold price that went above 1800, we must not forget that we had a gold price at one stage almost at $820 an ounce. That retreated back down. So there was a mixed bag, but that mixed bag throw into low liquidity, and you get these volatile swings. It's only really from today onwards that we have most of the players back into the markets, and that your liquidity will start coming back into the market, and that you can really see where things want to go.
Andre, the US Federal Reserve's December minutes were recently released. A more hawkish stance from Fed Jerome Powell, an increased rate of taper, and the interest rate increase are expected to be more frequent this year. Investment banks are adjusting their predictions about the rate hikes and the pace of the taper. What are the implications for, firstly, the dollar, and secondly, the rand?
Well, the dollar could benefit from that. If you look at the really textbook economics, it says higher rates, positive for a currency, inflow of money into the country, etc. That's the normal rhetoric thing regarding economics. Now, so it could benefit the dollar. However, I think that the dollar has benefited from this already in the last couple of weeks, call it the last 2-3 months, because that's where we had seen inflation at the higher levels, where it persisted at the levels, and where the Federal Reserve had actually admitted that inflation is not transitory anymore and that it's there to stay. Now, during the last release of the unemployment figures, we had also seen that unemployment is a little bit lower, and we had also seen that there is still further pressure on the wage bill, in the sense of higher increases for people, which adds to the inflation problem. But that's there, and we know it, and we've known it for a while. So if I say that the dollar can benefit, I am kind of the opinion that we've seen the benefit already, and that it will not have a major impact going forward. So I don't think that we'll have a dollar going down to the 110 or 111 against the euro. I think it will remain more or less at these levels, and we might very well see that it's a bit of a buy the rumor, sell the fact situation that will come through.
Some very interesting developments happening in Turkey. The central bank having to get involved to get that currency under control. We saw it balloon all the way out to 18 to the dollar. What exactly is happening in Turkey, and does this underpin the importance of an independent central bank?
I think you're very correct in saying that it underpins the importance of a central bank. What's happening in Turkey is kind of a mystery, because, the one day it's this and the next day it's that. What we have is a president that actually mingles in with the independence of a central bank, fires people if they don't dance to his tunes, then they get fired, and they in the firing squad. And then it doesn't really matter what a central bank does, whether they intervene to prop up the currency market or whatever they do will be in vain. You need to address the issue, and the issue lies with the government and the independence that gets taken away from all other institutions. So now that's not likely to change, and that will definitely not change in the short term. So that volatility from Turkey will be remaining with us for quite some time. We have to wait to see what happens during a next round of elections, and that's not on the cards for next week or the month or the 6 months forward. So Turkey and the trouble in Turkey will be with us, but I think what we're also seeing is that Turkey is having less of an impact on generally what happens in emerging markets, and it's actually decoupled itself and moving a little bit on its own. And I think that will continue and have less of an influence on what happens on emerging markets. So I think for the short term, one can actually park Turkey on the side, saying that it will have less of an impact, unless something dramatically happens to the positive side in terms of government and the stance of government to institutions, especially the central bank. That will definitely have a positive impact, but as far as the negatives is concerned, I think that will diminish a little bit in value as it's decoupled itself already from the emerging market space.
The commodity bull market seems to have run its course. How important are strong commodity prices to the local currency?
Well, we are a commodity currency. We should never forget that. And a very big part of our GDP still comes from the commodity side, from the mining sector. So we can never walk away and say that commodity prices or the level of commodity prices is of no interest to us. But you will know that I have, for a very, very long period now, said where people are speaking of a total decline or sinking in of commodity prices, that I think it will stabilize. The same sort of increases will not be there for this year, but I do think that economies throughout this year will continue on their growth path. I think if you look at the whole situation regarding Omicron, the new variant of COVID that came about, and the impact of that in Europe, and the increase in infections that there was in the lockdowns that came with it, and the curfew times, etc., that came and was embarked on in the European zone, I think that will dwindle over the next couple of weeks, 2 to 3 months, and that will put economies back onto the growth path. If you get economies onto the growth path and a return to more normality, then the demand will still be there for commodities, but it will not be a commodity boom, but it will stabilize commodities and keep prices at fairly stable levels and not on a massive decline. So from a South African perspective, I think we can look forward to still enjoying stability on that end without massive declines, and still a mining sector that benefits from the relatively high prices that we are currently seeing.
What would a global equity market correction mean for emerging market currencies, including the rand?
A global equity market correction will be negative for our equity market. It will be an outflow of money out of the equity market. Whether it will lead to an outflow of money out of the country, in my mind, is not something that will really happen. Our central bank still very independent, still very much in front of the curve, and we can expect interest rate increases, especially in the first half of this year, most probably 2, at most 3 increases. That will keep us at the front end of the curve. And as people move out of equity markets, they will move into fixed markets, fixed income markets, also in South Africa. So I don't think that a negative impact in terms of the currency is necessary on the cards in terms of that, as it will be a shifting and a change in portfolios of where you park your money whilst that correction is going on. And that would be on the fixed income markets.
Lastly, Andre, what do the technicals or the charts say about the rand dollar price action for the next few months?
Well, it happens to be that we're sitting close to some significant technical levels as we speak. We're speaking 1560. If we significantly break the 1560 and break away from that psychological level, then I think it's quite possible that we could move down to the 1550, 1548 levels in a very short space of time. Now, if I go back once again to our interviews of last year, I did say that I think that the rand can end the year most probably around the 1530, 1570 levels. Now, call me a liar for where we ended for 20 cents. In our volatility, I don't think it's that bad. And for now, I would call a little bit more strength down to the 1540, most probably 1530 levels. But from there, stabling out at those levels and then gradually moving up towards back towards the 16 levels. The significant one that we have to look at now is the budget speech of our Minister of Finance, whose first budget speech will be done in February. Now, of more concern to me is when a president starts speaking at a party for the ANC and they switch off the lights, and when they start burning down Parliament, and when they start breaking windows at the Constitutional Court, then as much as you want to, you can come and tell me that there's no attack on the democracy of the country. And I tell to you, I think you're keeping a blind eye here. So those things are of concern. We also have some violence that might erupt as people go back to universities and start burning down stuff because they want to gain access to the university without being vaccinated, and the university has got a policy of vaccination. So there's a few pitfalls lying ahead of us, and one of those is also then the Minister of Finance in his budget speech. So hence, I think slightly down and then moving gradually up to higher levels as we enter into the space of opening of Parliament, getting closer to the budget speech, and then we have to see what happens after that.